They told you he was a genius, a prophet, an oracle perched on a mountain of cash, divining the future of markets with an almost supernatural clarity. They showed you his face, gentle and grandfatherly, and paired it with headlines of his latest multi-billion-dollar conquest. The implication was always the same. Warren Buffett sees things you don't. He knows things you can't. His mind operates on a different plane, a higher frequency of predictive accuracy that you, the ambitious but earthbound mortal, can only aspire to. And so you try. You consume the news. You listen to the forecasts. You build complex models and chase the phantom of certainty, believing that if you could just get a little bit better at predicting the future, you could replicate his success. This belief, this entire paradigm, is the single greatest deception in the world of wealth creation. It is a carefully constructed myth designed to keep you running on a hamster wheel of activity, forever chasing a horizon that recedes with every step. Because the foundational secret to Warren Buffett's empire, the core programming of his mental operating system, has absolutely nothing to do with being right. It has everything to do with building a system so robust, so powerful, so fundamentally sound, that being wrong becomes an irrelevance. The nine-figure mistakes, the billion-dollar blunders, the entire decades where his judgment was proven flawed, they don't matter. They are absorbed, neutralized, and ultimately rendered impotent by the sheer architectural genius of his approach. He is not a better predictor, he is a better architect. While you have been taught to be a financial astrologer, staring at the stars and trying to guess the future, he has been quietly, methodically, building an ark. An ark designed from the ground up to withstand a flood of unpredictable chaos, unforeseen events, and, most importantly, the torrential downpour of his own human fallibility. This is not a documentary about how to be a better stock picker. This is a deconstruction of an entire psychological operating system for invincibility. We are going to hand you the blueprints to his ark, a system he gives a deceptively simple name, the margin of safety. But you will come to understand it as something far more profound, a cognitive fortress, built with 3 impenetrable walls that, once constructed, makes you immune to the forces that destroy 99% of investors. Prepare to uninstall the myth of the infallible oracle and install the operating system of the invincible architect. The year is 1963. In the unassuming town of Bayonne, New Jersey, a small, little-known company called Allied Crude Vegetable Oil Refining Corporation is humming along, a critical node in the vast network of global commodities. Its president, a man named Anthony Tino DeAngelis, is a master of appearances. He is seen as a shrewd, hard-working businessman, a pillar of the community, a man you could trust. His company's business model was, on the surface, brilliantly simple. They would take shipments of soybean and cottonseed oil, store it for major exporters like American Express, and charge a fee. In return, the exporters would receive warehouse receipts for the stored oil, which they could then use as collateral for loans. It was the boring, essential plumbing of international trade. But Tino DeAngelis had a secret held in the cavernous steel storage tanks that lined the waterfront. The warehouse receipts he was issuing corresponded to vastly more oil than he actually possessed. At first, it was a small fudge, a little exaggeration to secure a slightly larger loan. But then it grew. He discovered a simple, almost comical trick. He could fill the tanks mostly with water, with only a thin layer of valuable salad oil floating on top. When inspectors came to check, they would dip their testing tubes from the top, find the oil, and sign off on the paperwork. The lie grew from a puddle to a lake, and then to an ocean. By November of 1963, Tino's company had secured over $175 million in loans. That's over $1.5 billion in today's money, backed by phantom oil. He was running one of the largest and most audacious frauds in American history. And one of the company's most deeply exposed, the one whose reputation for trust was on the line for guaranteeing those warehouse receipts, was American Express, the credit card and traveler's check giant. A blue-chip stock, a bedrock institution of American finance. On November 19th, the House of Cards collapsed. Allied crude declared bankruptcy. The news broke that the tanks were full of water. The market, in its infinite wisdom, reacted with pure, unadulterated terror. The world's financial institutions realized they were holding collateral worth pennies on the dollar. A wave of panic selling slammed into American Express stock. Wall Street analysts, the so-called experts, the oracles of finance, declared that the company was facing ruin. The potential liabilities were unknown, but they were surely catastrophic. The stock, which had been trading at over $60 a share just weeks before, began a sickening plunge. It fell to $50, then $45. It bottomed out at $35 a share, a cataclysmic drop of nearly 50%. The consensus was clear: get out, sell. The brand is tarnished, the liabilities are endless, the company is finished. This is precisely the moment where the myth of the genius predictor dies and the reality of the master architect begins. In his small office in Omaha, Nebraska, a 33-year-old Warren Buffett watched this unfold not with panic, but with intense, predatory curiosity. He wasn't trying to predict the stock's bottom. He wasn't listening to the chorus of doom from Wall Street. He was asking a different set of questions. He was ignoring the noise and focusing on the machine. His first question was brutally simple. Is the core business, the actual money-making engine of American Express, being damaged by this scandal? He wasn't interested in the stock price. He was interested in the business reality. So he did something the highly paid analysts in New York never thought to do. He left his office and conducted his own on-the-ground investigation. He went to local banks. He talked to the tellers and managers. He asked them, "Are you still selling American Express travelers' checks? Are your customers still using them?" He went to restaurants and hotels. He observed. He asked proprietors, "Are you seeing any drop-off in the use of American Express cards or checks?" Everywhere he went, the answer was the same. The scandal was a Wall Street story, a financial abstraction. For the real-world customer holding a green card in their wallet or a pack of traveler's checks in their pocket, nothing had changed. The brand, the actual psychological contract of trust and convenience with the consumer, was completely unharmed. He then did a second thing. He analyzed the core economics of the traveler's check and credit card businesses. He realized that American Express had a powerful float. They collected money from customers up front for travelers' checks and only paid it out later, getting free use of billions of dollars in the meantime. This was a financial moat, a river of cash that was completely unaffected by the salad oil fiasco. So he had his answer. The fundamental business was sound. The brand was intact. The economic engine was powerful. Now for the second, crucial question. What is the company actually worth? He did the math. He calculated the company's earnings power from its core businesses, completely ignoring the noise from the scandal. He then made a conservative estimate of the maximum possible losses from the fraud. Even in a worst-case scenario, he concluded that the intrinsic value of the business, its true underlying worth, was at least $65 per share. The market, in its panic, was offering to sell him this $65 asset for $35. This is the moment of truth. This is the activation of the Ark Builder's operating system. The Wall Street astrologers were looking at the stormy skies, the scandal, the panic, the falling stock price, and predicting endless rain. Buffett was looking at the structural integrity of the ship. He saw that it was sound, and the market was offering to sell it to him for half of what it was worth. This massive gap between the price and the value was his margin of safety. It was his buffer against being wrong. What if his loss estimates were off? What if the scandal was a bit worse than he thought? It didn't matter. The 55% discount he was getting provided an enormous cushion. It was an intellectual and financial fortress. He didn't need to predict the exact moment the storm would pass. He didn't need to know when the stock would recover. He just needed to be approximately right about the long-term value of the business. The price provided the invincibility. And so, he acted. He invested 40% of his partnership's entire capital into American Express stock. It was the single largest investment he had ever made. A bet-the-farm decision that, to the outside world, looked like utter madness. Over the next 2 years, as the panic subsided and the true, limited nature of the salad oil losses became clear, the stock price didn't just recover. It soared. It passed its old high of $60 and kept climbing, eventually multiplying his partnership's money many times over. This story is the foundational text for understanding the rest of this documentary. It contains every element of the cognitive fortress we are about to deconstruct. It demonstrates a complete rejection of prediction and a total embrace of architecture. It reveals a mindset that thrives not on forecasting the weather, but on buying unsinkable ships at a discount when a hurricane is raging. The world calls it a brilliant investment. But that word, brilliant, implies a flash of genius, a moment of divine insight. It was nothing of the sort. It was the methodical execution of a psychological operating system, an operating system that you can learn, that you can install, and that we will now, piece by piece, reveal. Welcome to Part 1, The Myth of the Oracle. The human brain is a machine built for a single purpose, survival. For hundreds of thousands of years, on the plains of the Serengeti, our ancestors faced a world of lethal uncertainty. The rustle in the grass could be the wind, or it could be a lion. The strange-colored berry could be nutritious, or it could be poisonous. In this environment, the ability to rapidly detect patterns, to create a causal story from limited information, was a profound evolutionary advantage. The hominid, who assumed the rustle was a lion and ran away, survived, even if he was wrong 99 times out of 100. The hominid who assumed it was just the wind and was wrong just once was removed from the gene pool. We are the direct descendants of the paranoid, pattern-seeking survivors. Our brains are not wired for statistical accuracy. They are wired for narrative coherence. We are prediction machines. We are storytellers. We are constitutionally incapable of looking at a random series of events without trying to weave them into a meaningful tale. This is the source of all myth, all religion, all art. And it is the source of almost all catastrophic failure in the world of investing. This deep, primal need to predict the future manifests as a series of cognitive biases, mental glitches in our evolutionary programming that are ruthlessly exploited by the modern financial world. The first and most seductive is the narrative fallacy. Coined by the thinker Nassim Nicholas Taleb, it describes our tendency to create flawed stories of the past and then believe them as inevitable. Look at the rise of any great company, say Apple. In hindsight, the story seems so obvious, so preordained. A visionary founder, a series of game-changing products, a relentless focus on design. We read the biographies and watch the movies, and we nod along, as if this was the only way it could have possibly unfolded. We forget the near bankruptcy in the 1990s. We forget the countless product failures, the internal power struggles, the sheer, dumb luck that played a role. The messy, chaotic, unpredictable reality is laundered into a clean, simple, and deeply misleading story. This matters because these cleaned-up stories of the past become the basis for our predictions of the future. We look for the next. We read the biographies and watch the movies, and we nod along, as if this was the only way it could have possibly unfolded. We forget the near bankruptcy in the 1990s. We forget the countless product failures, the internal power struggles, the sheer dumb luck that played a role. The messy, chaotic, unpredictable reality is laundered into a clean, simple, and deeply misleading story. This matters because these cleaned-up stories of the past become the basis for our predictions of the future. We look for the next visionary founder, the next game-changing product, believing we can spot the pattern in advance. The financial media is a multi-billion-dollar industry built almost entirely on servicing this fallacy. Every day, it bombards you with stories. The market went up today because of positive inflation data. This stock fell because the CEO made a controversial statement. These are almost always post hoc rationalizations, simple stories slapped onto complex random events. There is no way to know the millions of individual reasons why millions of people bought or sold on a given day. But to say we don't know is unsatisfying to our narrative-hungry brains. So we invent a reason, and we start to believe our own inventions. This addiction to narrative makes us vulnerable to the second major glitch, the overconfidence bias. Because our stories of the past seem so coherent, we develop an exaggerated faith in our ability to predict the future. Study after study has shown that humans are chronically, and often dangerously, overconfident in their own judgments. A famous experiment asked a group of fund managers to predict the direction of the market over the next month. They were also asked to rate their confidence in their own prediction. The results were stunning. There was absolutely no correlation between their confidence and their accuracy. The most confident predictors were just as likely to be wrong as the least confident. Yet, they continued to make predictions, and we continued to listen to them. We mistake confidence for competence. The smooth-talking analyst on television, with his sharp suit and his precise price target, triggers the part of our brain that wants to believe in certainty. He is the modern-day shaman, interpreting the digital entrails of the market and telling us a story we want to hear. He is selling a drug, the drug of certainty, and we are eager addicts. Finally, there is the most insidious glitch of all, confirmation bias. This is our brain's tendency to seek out and favor information that confirms our pre-existing beliefs, and to ignore or discredit information that contradicts them. If you believe a certain stock is going to be a huge winner, you will subconsciously start to filter reality through that lens. You will click on the positive news articles. You will dismiss the bearish analyst report as the ramblings of a fool. You will interpret ambiguous data in the most favorable light. Your mind is no longer an objective analysis tool. It has become a lawyer, hired by your ego, whose only job is to build a case for your initial conclusion. You are no longer investing. You are validating. This toxic trinity of biases, the narrative fallacy, overconfidence, and confirmation, creates a perfect storm of self-delusion. It turns the aspiring investor into a sleepwalker, navigating a minefield while dreaming of a promised land. They believe they are making rational, data-driven decisions, when in reality they are merely acting out the scripts of stories they have told themselves. They are not engaging with reality. They are engaging with their own mental projections of reality. This is the psychological prison that traps 99% of market participants. Warren Buffett's first and most profound act of genius was not in picking stocks, but in recognizing the existence of this prison. He understood, at a fundamental level, that his own brain was just as flawed, just as susceptible to these biases as anyone else's. He knew that he was not, and could never be, a reliable oracle. His intelligence was not in having a better crystal ball, but in knowing that all crystal balls are broken. This profound intellectual humility is the bedrock of everything that follows. It is the realization that trying to be a better predictor is a loser's game. The only winning move is to refuse to play. The only path to success is to design a system, an architecture that does not depend on prediction for its survival. A system that acknowledges the certainty of storms and focuses only on building an unsinkable ship. This brings us to the central metaphor of our documentary, the architect versus the astrologer. The vast majority of the financial world, from the individual day trader to the multi-billion-dollar hedge fund, operates as a collective of financial astrologers. They study the charts, the economic data, the geopolitical tea leaves, all in an attempt to divine the future. Their language is the language of prediction. We forecast GDP growth of 2%. Our year-end price target for the S&P 500 is 5,000. We believe this technology will be the next big thing. They build their entire professional existence on the pretense of knowing what is to come. Their business model is to sell these predictions to a public desperate for certainty. They are masters of the narrative, weaving compelling stories about why their particular divination is the correct one. But at its core, it is a sophisticated form of fortune-telling. And like all forms of fortune-telling, it is destined to fail, because the future is a complex, adaptive system that is fundamentally and irreducibly unpredictable. There are too many variables, too many feedback loops, too many unknown unknowns. A single technological breakthrough, a surprise election result, a random geopolitical event, a global pandemic. Any of these can shatter the most carefully constructed forecast in an instant. The astrologer's response to this inherent uncertainty is to build more complex models. They hire PhDs in physics and mathematics to engage in what Buffett derisively calls high-tech praying. They believe that with enough data and enough processing power, they can tame the randomness and bend the future to their will. This is a fallacy. Adding complexity to a forecast does not make it more accurate. It often just makes it more fragile. It creates more potential points of failure, more assumptions that need to be correct. The astrologer is trapped in an intellectual arms race against an infinitely complex reality, a race they can never win. The architect, on the other hand, begins with a completely different premise. The architect accepts the future's unpredictability as a foundational law of nature, as certain as gravity. He wastes no cognitive energy trying to forecast the precise path of the next hurricane. Instead, he dedicates all of his effort to a single question. How do I design a structure that can withstand any storm, even one whose force and direction I cannot possibly know in advance? The architect's language is not the language of prediction, but of resilience, of durability, of structural integrity. He is not concerned with what the market will do next week, next month, or next year. He is concerned with one thing and one thing only: owning assets so robust and owning them at a price so advantageous that he can comfortably endure and even profit from the inevitable storms of market volatility and human error. This is not a passive philosophy. It is an active, disciplined, and deeply intellectual process of stress-testing reality. The architect is not a blind optimist. He is a hyper-realist. He assumes that chaos is the default state of the world. He assumes that his own analysis will be flawed. He assumes that the management of the companies he invests in will make mistakes. He assumes the worst, not out of pessimism, but out of a profound commitment to survival. The astrologer seeks to be right. The architect seeks to be unbreakable. The astrologer builds a portfolio of hopes and predictions. The architect builds a portfolio of interlocking redundancies and buffers. When the inevitable storm comes, the market crash, the recession, the black swan event, the astrologer's beautifully complex but fragile predictions are shattered. He is exposed, ruined, and forced to start again, often with a new, even more compelling story about why this time will be different. The architect, meanwhile, sits calmly inside his fortress. The storm may rage, the value of his assets may fluctuate wildly on paper, but the underlying integrity of his structure remains sound. He might even venture out into the storm, using his reserves of capital and emotional stability to purchase the ruined assets of the failed astrologers at bargain prices. This is the fundamental cognitive shift required to understand the Buffett operating system. You must kill the astrologer in your own mind. You must mercilessly purge the desire to predict. You must abandon the ego-driven need to be seen as right. You must, instead, cultivate the humble, methodical, and infinitely more powerful mindset of the architect. You must fall in love with the process of building a fortress, not the thrill of placing a bet. In the coming chapters, we will hand you the detailed schematics for this fortress. We will deconstruct its three great walls, the interlocking pillars of the margin of safety. But first, you must make a choice. Will you continue to stare at the stars, hoping to guess the future? Or will you pick up a hammer and start building your ark? Welcome to Part 2, the Cognitive Fortress. A fortress is not a single entity. It is a system of interlocking defenses. The outer wall, the moat, the keep, the ramparts, each is designed to repel a different kind of attack and to provide a backup if another layer is breached. The margin of safety, as envisioned by Buffett and his mentor Benjamin Graham, is precisely such a system. It is not a single number on a spreadsheet. It is a multi-layered cognitive and financial fortress designed to protect you from a triad of relentless enemies, a volatile and unpredictable world, the errors of other people, and most importantly, the profound and unavoidable fallibility of your own mind. We will now deconstruct this fortress into its three primary walls, the three great pillars that provide its structural integrity. Each pillar is a margin of safety in its own right, and together, they create a state of near financial invincibility. The first and most famous of these walls is the price fortress. This is the pillar that Benjamin Graham built his entire philosophy upon, and it is the easiest to understand mathematically, but the hardest to execute psychologically. The core concept is brutally simple: never pay full price. Always demand a significant discount on the true underlying value of any asset you buy. As Buffett famously says, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. But his career is built on the moments he could do one better: buy a wonderful company at a wonderful price. The mathematical logic is straightforward. If your analysis tells you that a business is worth $100 per share, you do not buy it at 95. You do not buy it at 90. You wait, with the patience of a predator, until the market, in a fit of panic or pessimism, offers it to you for $50 or $60. This $50 gap between the intrinsic value and your purchase price is the margin of safety. It is a massive financial buffer, but its true power is psychological. The price buffer is a tangible admission of your own fallibility. It is a preemptive defense against the certainty that your own analysis is, in some way, wrong. Maybe your estimate of the company's future earnings was too optimistic. Maybe you overlooked a new competitive threat. Maybe your valuation of $100 per share was off by 10, 20, or even 30%. For the investor who paid $95, such an error is devastating. They are immediately underwater, their capital is impaired, and they are forced into a psychologically taxing position of hoping to get back to even. For the investor who paid $50, the same analytical error is a non-event. Even if the true value was only $80, they still have a massive cushion. The margin of safety absorbed the full impact of their mistake. It made being wrong irrelevant. This is a profound shift in mindset. You are no longer trying to achieve perfect precision in your valuation. You are instead seeking a discount so large that it renders precision unnecessary. You are aiming for results that are, in Graham's words, satisfactory rather than brilliant. You are trying to be approximately right and letting the price you pay protect you from the consequences of not being exactly right. The concept of intrinsic value is key here. It is the anchor point from which the margin of safety is measured. Intrinsic value is the discounted value of the cash that can be taken out of a business during its remaining life. It is an estimate of a business's true underlying economic worth, completely independent of its fluctuating stock price. Calculating it is part art, part science. But the key is not to find a precise number, but to find a conservative range. The architect does not need to know if the business is worth exactly $100 or $110. He only needs to be confident that it is worth substantially more than the $50 price tag the market is currently offering. To build this price fortress, one must cultivate a specific psychological trait, a deep and abiding contrarianism. You must train yourself to view market panic not as a threat, but as an opportunity. You must learn to be greedy when others are fearful. The greatest discounts, the most magnificent margins of safety are only ever offered during times of maximum pessimism. They are born from fear, from uncertainty, from forced selling, from the kind of widespread panic we saw in the American Express salad oil scandal. That story is the quintessential example of the price fortress in action. Let us return to that moment in 1963, but this time let's go deeper into the psychology of the event. Imagine you are a professional money manager in New York at that time. Your entire world is built on consensus, on staying close to the herd. If you buy American Express and it goes to zero, and everyone else was selling it, you will be fired, your career will be over, you will be branded an idiot. If, however, you sell American Express along with everyone else, and it turns out to be a mistake and the stock triples, you will suffer no professional consequences. You can simply say, "Nobody saw it coming." There is immense professional safety in being conventionally wrong. This institutional imperative creates a powerful force that exaggerates market swings. Fear becomes contagious. Selling begets more selling, not because of new information, but because of social proof. Everyone is running for the exit, so the logical thing to do is to run for the exit too. This is the engine that creates opportunity for the architect. Buffett, alone in his Omaha office, was insulated from this psychological contagion. He was not part of the club. He had no career risk associated with being different. His only duty was to his partners and to rationality. This insulation allowed him to perform the simple but not easy task of separating the temporary problem, the salad oil fraud, from the enduring business, the traveler's checks and credit cards. The market was conflating the two. It was pricing the company as if the fraud had permanently crippled its entire operation. This was a catastrophic analytical error, driven by pure emotion. Buffett's great insight was to recognize it as such. His investigation, talking to bankers, merchants, and customers, wasn't about finding some secret piece of information. It was about confirming a simple, observable reality that the panicked market had completely forgotten. People still trusted the American Express brand. The brand was the true asset, and it was untouched. When he concluded the business was worth at least $65, and the market was offering it for $35, he wasn't making a prediction, he was making an observation. He was observing a massive dislocation between price and value. The decision to invest 40% of his partnership was not a reckless gamble. From his perspective, it was the safest, most conservative decision he could possibly make. Where was the risk in buying a $65 asset for $35? The real risk, he would argue, was in not doing it. The real risk was in paying $95 for a $100 asset in a calm market. The price fortress is therefore not just a quantitative tool, but a behavioral one. It is a discipline that forces you to act against the crowd, to buy pessimism and sell euphoria. It requires supreme emotional control, a deep-seated confidence in your own analysis, and the patience to wait, sometimes for years, for the perfect pitch. Most people lack this patience. Their internal wiring, their addiction to activity, makes it impossible for them to sit and do nothing. They feel they must always be in the game. The architect knows that the game is won by the players who only swing at the fat pitches. The margin of safety is the fat pitch. It is the rare and wonderful moment when the market's emotional insanity serves you up an opportunity on a silver platter. Building the price fortress means organizing your entire financial life around being ready, financially and psychologically, to act decisively when those moments arrive. But a low price alone is not enough. A cheap asset can always get cheaper, and a failing business bought at a 50% discount is still a failing business. The price fortress is the outer wall, designed to absorb the first wave of attack. But for true, long-term invincibility, you need a second, even more formidable layer of defense. You need an inner keep, a structure of such profound strength and durability that it can withstand almost any external shock. This brings us to the second great pillar of the cognitive fortress, the quality fortress. This is the wall that Buffett, with the crucial influence of his partner Charlie Munger, spent the latter half of his career perfecting. It represents a profound evolution from the classic Graham-style cigar butt investing, which focused on buying statistically cheap but often mediocre businesses. The quality fortress is built on a simple, powerful idea. The best margin of safety is not just a low price, but the enduring competitive advantage of a truly wonderful business. This is the concept of the economic moat. An economic moat is a structural advantage that protects a company from competition, much like a real moat protects a castle. It is a barrier that makes it difficult for rivals to attack the company's profits and market share. A business with a wide, sustainable moat can earn high returns on capital for very long periods of time, compounding its value year after year. It can weather recessions, survive incompetent management, and adapt to technological change. The moat itself is the margin of safety. It is a buffer against the relentless forces of capitalism that seek to erode all excess profits. For Buffett and Munger, identifying the presence and durability of a moat became the most important part of their investment analysis. A wide moat allows a company to be a price maker rather than a price taker. It gives it pricing power, the ability to raise prices without losing significant business to competitors. This is a crucial defense against inflation and a powerful engine of long-term value creation. They identified 4 primary types of economic moats, 4 blueprints for building a quality fortress. The first is intangible assets. This includes things like brands, patents, and regulatory licenses that are difficult or impossible for competitors to replicate. The Coca-Cola brand is perhaps the most famous example. For over a century, the company has spent billions of dollars building a psychological association in the minds of people around the globe. When you think of refreshment, of happiness, of a classic American experience, you think of Coke. This mental real estate is an almost impenetrable fortress. A competitor could create a soda that tastes identical and even sell it for less, but they cannot replicate the brand. The brand allows Coca-Cola to charge a premium price and command enormous market share, year after year, decade after decade. The story of New Coke in 1985 is a perfect illustration of this moat's power. The company, in a fit of corporate anxiety over Pepsi's market share gains, decided to change its sacred formula. On a purely rational, taste test level, New Coke was preferred. But the public reaction was not rational. It was emotional. It was a visceral outcry, a sense of betrayal. People felt that something core to their identity had been taken away. The company was forced into a humiliating retreat, bringing back quote, 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 quote. The lesson was profound. The company didn't just sell sugar water. It sold an idea, a memory, a piece of culture. That intangible asset was its true fortress. The second type of moat is switching costs. This exists when it is too expensive, too time-consuming, or too risky for a customer to switch from one provider to another. Think of the operating system on your computer. Whether it's Windows or Mac OS, the cost and hassle of switching all of your software, files, and learned habits to a new system is immense, even if a competitor offered a slightly better or cheaper alternative. This creates a powerful lock-in effect. Enterprise software companies like Oracle or SAP are masters of this moat. Once their systems are deeply embedded in a corporation's core processes, ripping them out is like performing open-heart surgery. The switching costs are so high that they can maintain their customer base and charge lucrative fees for decades. This moat is a fortress built on inertia and inconvenience. The third moat is the network effect. This is a powerful phenomenon where a product or service becomes more valuable as more people use it. The classic example is a telephone network. One phone is useless. 2 phones create a small network. 1 billion phones create an indispensable part of modern life. Credit cards are a perfect modern example. Visa and MasterCard have a duopoly built on a 2-sided network effect. Merchants accept Visa because billions of customers have Visa cards. Customers carry Visa cards because millions of merchants accept them. For a new competitor to break into this market, they would have to convince millions of merchants and billions of customers to switch simultaneously, an almost impossible task. The network itself is the fortress, a self-reinforcing loop of value that grows stronger with each new user. The fourth and final moat is a cost advantage. This is the ability of a company to produce a good or service at a lower cost than its rivals, allowing it to either undercut them on price or earn higher profits. This can come from scale, like Walmart's ability to use its immense purchasing power to demand lower prices from suppliers. It can come from a unique process, like the assembly line that Henry Ford pioneered. Or it can come from a unique geographical location, like a quarry that owns the only source of a specific type of limestone. Geico, one of Buffett's most successful investments, is a prime example of a fortress built on a structural cost advantage. For decades, the auto insurance industry was dominated by companies that used a network of agents to sell policies. these agents had to be paid a commission, which was built into the price of the policy. Geico pioneered a direct-to-consumer model, first through mail and then through the telephone and internet. By cutting out the agent, they permanently removed a layer of cost from their operations. This allowed them to offer lower prices than their competitors, creating a virtuous cycle. Lower prices attracted more customers, which gave them greater scale, which allowed them to lower their costs even further. This structural advantage was a deep, wide, and almost unbreachable moat. The evolution of Buffett's thinking towards the quality fortress is best captured in the story of See's Candies, which he and Munger purchased in 1972. At the time, it seemed like a departure. See's was not a statistically cheap, cigar-butt type of investment. They paid a price that was 3 times its book value, a premium that would have made a younger, Graham-trained Buffett balk. But what they were buying was not just a collection of assets. They were buying a regional brand with a fanatical following and incredible pricing power. See's Candies was a beloved institution in California. People associated it with holidays, with family, with quality. This powerful brand loyalty gave the company a crucial power, the ability to raise its prices every year, just a little bit, without any loss of business. A 10-cent increase on a pound of chocolates was barely noticed by the adoring customer, but when multiplied across millions of transactions, it translated into a significant increase in profits, all without needing any additional capital investment. This was a revelation for Buffett. He called it the ideal business, one that can over time increase its earnings and its dividends without having to put up more capital. He realized that the premium price they paid for See's was more than justified by the quality of the business and its economic moat. The brand was the margin of safety. It protected the business from inflation and competition. See's became their model for the quality fortress. It taught them that it was better to pay a fair price for a business that would grow in value for decades than to get a bargain price on a mediocre business that was in a constant struggle for survival. The quality fortress and the price fortress work together in a powerful symbiosis. The ideal investment, the one that creates true invincibility, is when you can find a company with a wide, durable economic moat that for some reason is temporarily on sale at a significant discount to its intrinsic value. This is the Holy Grail. This is the American Express salad oil situation. A great fortress, temporarily misunderstood and mispriced by a panicked mob. When you find this combination, you are no longer just investing. You are stacking the odds so heavily in your favor that it becomes difficult to lose. You have a buffer against your own valuation errors, price fortress, and a buffer against the chaotic forces of the business world, quality fortress. You are protected from both internal and external threats. You have built a keep within a castle wall. But even the strongest fortress can fall if the commander inside loses his nerve. A castle with impenetrable walls is useless if its lord opens the gates to the enemy out of fear or greed. The most sophisticated financial analysis and the most durable business moats are rendered worthless if they are not governed by a sound and disciplined mind. This brings us to the third, final, and most important wall of the cognitive fortress, the temperament fortress. This is the margin of safety against yourself. It is the psychological armor that protects you from your own worst enemy, the emotional, impulsive, pattern-seeking primate brain that resides in your skull. Buffett himself has been unequivocally clear on this point. He has stated, the most important quality for an investor is temperament, not intellect. He believes that controlling your emotions is the single most critical factor for success. You can have a 160 IQ, you can be able to perform complex financial calculations in your head, but if you are prone to panic in a downturn or get swept up in the euphoria of a bubble, you are destined to fail. The temperament fortress is built on a single, powerful mental model, a parable created by Benjamin Graham that Buffett considers the most important lesson he ever learned. It is the story of Mr. Market. Graham asks you to imagine that you are a partner in a private business, and your only other partner is a man named Mr. Market. Every day, without fail, Mr. Market shows up at your door and offers to either buy your share of the business or sell you his at a specific price. The crucial thing to understand about Mr. Market is that he is a manic depressive. Some days, he arrives in a state of wild euphoria. He sees only a rosy future for the business, and he quotes you a ridiculously high price for your share. On other days, he is inconsolably pessimistic. He is convinced that the business and the world are heading for ruin, and he offers to sell you his share at a desperately low price. He is always there, every day, screaming a price at you. You have two crucial advantages in this partnership. First, you are under no obligation to trade with him. You can listen to his offer and simply say no thank you, and go about your day. Second, his emotional state has absolutely zero to do with the underlying reality of the business. The business itself is chugging along, producing its goods, serving its customers, and generating cash. Mr. Market's mood is a complete fiction, a reflection of his own psychological state, not the company's performance. This simple parable is a psychological masterstroke. It reframes the entire experience of stock market volatility. The stock market is no longer a source of objective information, an all-knowing judge passing sentence on your investments. It is Mr. Market. It is your crazy, emotional, and ultimately harmless business partner. The ticker tape, with its flashing red and green numbers, is just Mr. Market having one of his mood swings. A 50% drop in a stock's price is not a verdict on its value. It is simply Mr. Market showing up at your door in a state of profound depression, offering you a bargain. This mental model is a powerful tool for emotional detachment. It allows you to separate the reality of the business you own from the noise of its daily price quotation. You are the rational partner. You know what the business is worth. You can choose to ignore Mr. Market on most days. You only engage with him on the rare occasions when his mood swings to an extreme. When he is euphoric, you might consider selling him your share at his silly high price. When he is despondent, you can take advantage of his pessimism and buy his share at a ridiculously low price. You use his emotion as an opportunity, not as a source of information. The person who allows Mr. Market to influence their own emotional state is doomed. If you feel euphoric when he quotes a high price and depressed when he quotes a low one, you have become his psychological slave. You have allowed his fiction to become your reality. You will inevitably buy high and sell low, the exact opposite of what is required for success. The temperament fortress is the discipline of treating the stock market as your servant, not your guide. It is the ability to form your own, independent judgment of a business's value and hold to it, even when the entire world, as personified by Mr. Market, is screaming that you are wrong. This requires a level of emotional resilience that is rare. It is, in essence, a practical application of Stoic philosophy. The Stoics taught the dichotomy of control, the idea that one must learn to differentiate between what one can control and what one cannot. You cannot control the economy. You cannot control the direction of the stock market. You cannot control the manic depressive moods of Mr. Market. Wasting any mental or emotional energy on these things is a form of insanity. What can you control? You can control your own research process. You can control the price you are willing to pay for an asset. You can control your own emotional reactions. The Stoic investor, the architect of the temperament fortress, focuses all of their energy on this small circle of control. They build a robust analytical process, they patiently wait for a price that offers a margin of safety, and they cultivate a state of psychological equanimity, a detachment from the uncontrollable noise of the market. This is why Buffett is able to sit on billions of dollars of cash for years at a time, seemingly doing nothing. He is not doing nothing. He is manning his fortress. He is waiting for Mr. Market to have a breakdown. He knows that eventually, inevitably, fear will grip the herd, and his crazy partner will show up at his door, offering to sell him wonderful businesses at wonderful prices. His patience is not passive, it is predatory. The three pillars are now complete. The price fortress protects you from valuation error. The quality fortress protects you from business and competitive disruption. The temperament fortress protects you from your own emotional folly. Together, they form a cognitive system of interlocking defenses. A breach in one wall can be contained by the strength of the others. If you make a mistake in assessing the quality of a business's moat, a sufficiently low purchase price can still bail you out. If the price you paid was only fair, not wonderful, the enduring strength of a wide moat business can still generate satisfactory returns over time. And if you have built your temperament fortress, you will have the psychological stability to hold on through the inevitable periods of volatility and doubt, allowing the other two pillars to do their work. This is the architecture of invincibility. It is a system designed not for brilliance, but for survival. It is a humble acknowledgement of the world's complexity and one's own limitations. It is the quiet, methodical, and relentless work of the ark builder, who continues his labor while the astrologers on the shore mock his efforts, oblivious to the gathering clouds. Welcome to Part 3, The Fortress Under Siege. A fortress is not a monument. It is a functional piece of military architecture, designed for one purpose: to withstand an attack. Its true strength is only revealed under siege. In this chapter, we will examine how the three-pillared cognitive fortress performs under the extreme stress of real-world chaos. We will see how a portfolio built on these principles doesn't just survive downturns, but can actually be strengthened by them, a concept known as anti-fragility. The term anti-fragile, coined by Nassim Taleb, describes things that gain from disorder. A fragile object, like a teacup, breaks under stress. A robust object, like a steel bar, resists stress. An anti-fragile object, however, gets stronger from stress. The human immune system is a perfect example. When exposed to a pathogen, it is stressed, but it learns and adapts, becoming stronger and better prepared for future attacks. A portfolio constructed with the three pillars of the margin of safety operates in a similar way. When the stress of a market crash arrives, the fragile portfolios, those built on leverage, on predictions of the future, on hype and narrative, shatter. The robust portfolios, those that are merely diversified across mainstream assets, may survive, but they are damaged and diminished. The anti-fragile portfolio, however, can emerge from the chaos in a stronger position than it entered. Here's how. First, the quality fortress acts as a fundamental shock absorber. During a recession, weak, unmoated businesses go bankrupt. Their sales plummet, their debt becomes unmanageable, and they disappear. The wide moat companies, however, often see their competitive position strengthen. Their weaker rivals fall by the wayside, allowing them to gain market share. Their strong balance sheets allow them to continue investing for the long term, while others are fighting for survival. The recession, the source of stress, actually culls the herd and widens their moat. Second, the price fortress provides the fuel for anti-fragility. Because the architect insisted on a massive discount at the time of purchase, even a 50% market crash may only bring the price of his assets back down to their intrinsic value. He is not suffering a catastrophic loss, he is simply seeing his paper profits evaporate. This leaves him psychologically and financially intact. He is not a forced seller. In fact, he is a potential buyer. Finally, the temperament fortress provides the command and control. The architect, secure in his emotional and intellectual fortress, views the widespread panic not as a threat, but as the greatest opportunity he has seen in a decade. Mr. Market is having a full-blown psychotic episode, offering to sell the world's greatest businesses for pennies on the dollar. While others are capitulating, he is deploying his reserves of cash, buying the assets that the fragile investors are being forced to liquidate. The crash, therefore, becomes a mechanism for transferring wealth from the fragile to the anti-fragile. The architect's portfolio is not just surviving the fire, it is using the fire to forge itself into a stronger, more valuable entity. This is the ultimate payoff of the entire system. It is a strategy that thrives on the one thing we can be certain the future will provide: periodic episodes of chaos, panic, and disorder. To truly understand this principle in action, we must turn to what is perhaps the single greatest story of a fortress under siege in modern financial history. It is the story of Warren Buffett's investment in the Washington Post Company in the mid-1970s. It is a masterclass in price, quality, and, above all, temperament. The year is 1973. The American stock market is in the early stages of a brutal, soul-crushing bear market. The Nifty 50, a group of beloved blue-chip stocks like Polaroid and Xerox that were once considered one-decision investments you could buy and hold forever, are collapsing under the weight of their own absurd valuations. The economy is racked by stagflation, a toxic combination of low growth and high inflation. The Watergate scandal is exploding, creating a crisis of confidence in the nation's institutions. The mood is one of deep, pervasive gloom. Mr. Market is not just depressed, he is suicidal. Amidst this chaos, the Washington Post, the very newspaper that was breaking the Watergate story, went public. It was a wonderful business. It had a near-monopoly position in its market. In a world before the internet, the local newspaper was the indispensable source of information and the primary platform for advertising. The Post had a powerful brand, an unassailable distribution network, and a deep connection with its community. It had a wide and durable economic moat. It was a quality fortress. But the timing of its IPO was terrible. The company's stock, along with the rest of the market, began to fall. By 1973, Buffett was able to start buying shares at an average price of around $23. But here is where his analysis transcended the ordinary. He didn't just look at the company's reported earnings, he looked deeper, into its true economic reality. He asked, what is this entire business worth? He valued the newspaper itself. He valued the company's television stations. He valued its other assets, like Newsweek magazine. His conservative calculation of the company's intrinsic value was at least $80 per share, and the market was offering it to him for $23. The price fortress was in place. The margin of safety was enormous, over 70%. He was buying a dollar for less than 30 cents. He began to buy and buy aggressively. By the middle of 1973, he had invested over $10 million, acquiring a huge stake in the company. And then, the siege began. The bear market intensified. The economy worsened. The stock market continued to plunge. The Washington Post's stock, despite its quality and the cheap price Buffett had paid, did not go up. It went down. And it stayed down. It fell from the $23 he had paid to $20, then to $17. For almost 3 years, Warren Buffett's single largest investment was a sea of red ink. Imagine the psychological pressure. This was not a quick, V-shaped recovery like the American Express story. This was a long, grinding test of conviction. The entire world was telling him he was wrong. The stock price, Mr. Market's daily verdict, was screaming at him that he had made a terrible mistake. Lesser investors, even professional ones, would have cracked. They would have started to doubt their own analysis. Maybe I missed something, they would whisper. Maybe the world has changed. Maybe newspapers are doomed. Their confirmation bias would kick in, and they would start looking for reasons to justify selling, to cut their losses and end the psychological pain. This is where the temperament fortress proved to be the most critical pillar. Buffett did not waver. He did not panic. He calmly ignored Mr. Market's daily hysteria. Why? Because his conviction was not based on the stock price. It was based on his own independent analysis of the business's value. He would later write, quote, "I can't be involved in a business where the price of the stock is telling me what I think. The business should be telling me what the stock is worth." As long as the business itself remained a first-class enterprise, as long as people in Washington, D.C. were still reading the paper and businesses were still buying ads, the daily fluctuations of the stock price were nothing more than noise. He held. And he waited. For years. Then, slowly, as the economy began to recover and the market's mood shifted from terror to mere pessimism, the price began to reflect the reality. the stock started to climb. It went back to 23, then 30, then 50. It passed his initial estimate of $80 in value and kept going. Over the next decade, the investment in the Washington Post would become one of the cornerstones of his fortune, eventually turning his $10 million investment into over $1 billion, a 100-fold return. The story of the Washington Post is the ultimate testament to the three-pillar system. The quality fortress of the business moat gave it the resilience to survive the harsh economic environment. The price fortress he demanded at the outset gave him a massive buffer against a declining market and a long period of stagnation. But it was the temperament fortress, his unshakable emotional and intellectual discipline, that allowed him to endure the siege and reap the phenomenal rewards. He did not predict the end of the bear market, he did not predict the economic recovery, he did not predict when the stock would finally turn, he didn't have to. He had built an ark, and he simply waited for the storm to pass, knowing that the structural integrity of his vessel was sound. This is the end game of the architect's mindset. It is not about a single brilliant move. It is about constructing a system so sound that it makes you the master of your own destiny, immune to the emotional whims of the crowd and the unpredictable chaos of the world. It is about building a fortress that cannot be taken, and then having the patience and courage to man its walls, even in the darkest of nights. Welcome to Part 4, Installation and the Bridge. We have journeyed through the deconstruction of a myth and the reconstruction of a powerful reality. We have exposed the fallacy of the oracle and have handed you the blueprints for the architect's fortress. We have seen how its three great walls, price, quality, and temperament, work in concert to create a system of profound resilience and long-term prosperity. Now the final and most important step remains. It is time to move from theory to practice. It is time to install this operating system onto your own mental hardware. This is not a matter of memorizing formulas or following a rigid checklist. It is a matter of cultivating a new way of seeing, a new way of thinking, a fundamental shift in your relationship with money, with risk, and with your own mind. To begin the installation, you must first run a diagnostic on your current system. For the next week, I want you to observe your own financial thoughts with a detached curiosity. When you read a financial headline, what is your emotional reaction? When a stock you own goes down, what is the story you tell yourself? When you hear an expert make a confident prediction, do you feel a sense of certainty or a healthy dose of skepticism? Be honest. You are likely to find the remnants of the astrologer's code running in the background, a desire for certainty, a susceptibility to narrative, an impatience for action. The first step is to simply be aware of this code, acknowledge it without judgment. Now we begin the installation of the architect's code by boiling down the three pillars into a simple, actionable mental checklist that you can run before making any significant capital allocation decision. Think of it as your pre-flight check. Question 1, the price test. Have I built a fortress against my own flawed judgment? This question forces you to confront your own fallibility head-on. It is not just, is this price fair? It is this price so compellingly cheap that it provides a massive cushion for the inevitable errors in my analysis? To answer this, you must have a conservative, well-reasoned estimate of the asset's intrinsic value, and you must have the discipline to demand a significant discount from that value. If you cannot confidently say that you are buying a dollar for 50 or 60 cents, you do not proceed. The default answer is always no. Question 2, the quality test. Is there a structural fortress protecting this business from the forces of chaos and competition? This question forces you to think like a long-term business owner, not a short-term stock trader. You must be able to clearly identify and articulate the company's economic moat. Is it a powerful brand? High switching costs, a network effect, a cost advantage. If you cannot describe the moat in simple, clear language, then you have not done the work. You are not buying a fortress. You are buying an open field, vulnerable to attack from all sides. The default answer is always no. Question 3. The temperament test. Am I psychologically prepared to be proven wrong by the market for a long period of time, even if my analysis of the business is right? This is the most personal and perhaps the most important question. It forces you to stress test your own emotional resilience. Imagine buying this asset and then watching it immediately fall by 50%. Imagine it staying there for 3 years while headlines mock your decision and everyone you know tells you to sell. Would your conviction waver? Would you panic? If the answer is yes, then you are not ready. Your temperament fortress is not yet built. You must pass on the opportunity, because even the best analysis is useless without the emotional fortitude to see it through. The default answer is always no. Notice the power of this checklist. It is a system of no's. It is designed to prevent action, not to encourage it. It is a filter that will screen out 99% of the so-called opportunities that come your way. This is its purpose. It is the manifestation of the strategic inaction we discussed in our first documentary. It forces you to wait for the rare, once-in-a-decade confluence of a wonderful business being offered at a wonderful price, to an investor who is psychologically prepared to act. When all 3 questions can be answered with a resounding yes, then and only then do you act. And you act with conviction. You don't dip a toe, you back up the truck. Because you are not gambling, you are not predicting, you are executing a carefully planned maneuver, based on a deep understanding of the architecture of invincibility. You are moving with the quiet confidence of the fortress builder who knows he has stacked every possible odd in his favor. This operating system will change you. It will slow you down. It will make you more patient, more selective, and infinitely more deliberate. You will begin to see the daily noise of the financial media for what it is, a chaotic and irrelevant distraction. You will see market crashes not as moments of fear, but as moments of rare and wonderful opportunity. You will move from being a pawn in the game, moved by the forces of fear and greed, to a player who understands the deep structure of the board. You will, in essence, stop being the astrologer and start being the architect. You will stop trying to predict the future and start building a system that is immune to it. You have learned how to build the fortress. You have the blueprint for the 3 walls: price, quality, and temperament. But a fortress is useless if you're constantly wandering outside its gates, distracted by every noise and rumor in the wilderness. The single greatest threat to your financial invincibility is not a market crash. It's the slow, constant leak of your cognitive energy into things that don't matter. It's the hot tip, the new trend, the siren song of complexity that threatens to pull your focus and your capital into territories you don't understand. Buffett's system for defining the perimeter of your fortress, for deciding where you will and will not even think, is called the circle of competence. It's the security system that guards the gates. It dictates the very ground upon which you will build. Mastering the margin of safety protects you when you act, but mastering the circle of competence protects your most valuable asset, your cognitive energy, before you even consider acting. To understand how to construct this impenetrable mental perimeter, how to define your cognitive territory and plug the leaks in your own mental bucket forever, click the video on your screen now. It is the essential next step in completing your psychological operating system for wealth.